Welcome back to the deep dive. Our mission today is pretty laser focused. We are handing you the blueprint for a crisis that's hiding in plain sight.
A crisis that really threatens to, well, fundamentally reset the American financial landscape.
We are diving deep into what's being called the commercial real estate cliff.
And it's a massive, largely unspoken ticking time bomb. We're talking about a staggering $1.5 trillion in maturing debt.
And that number, that $1.5 trillion, it isn't just a statistic you hear on the news. It actually dictates how we should be viewing the world around us.
Exactly. When you look up in, say, downtown San Francisco or Chicago or Midtown Manhattan, you might see these towering monuments of American capitalism.
Right, symbols of success.
But if you're what we call smart money, if you're actually looking at the balance sheets, you see something entirely different.
What do you see?
You see ghost towers.
Ghost towers. That is the perfect metaphor. It really captures the silent, insidious nature of this problem.
It does, because for the casual observer, the lights are on, the lobbies look polished, everything seems fine.
But underneath that shiny veneer, the data is just shocking. We're looking at a national office space vacancy rate of nearly 20%.
And that's the national average. When you zero in on those major cities, the big, expensive hubs,
The places that bet everything on the office.
Boston, New York, San Francisco, we're looking at vacancy rates closer to 30%. In some cases, they are pushing 40%.
Just think about that for a second. 1 in 3, maybe even closer to 1 in 2 desks are just permanently empty.
But here's the crucial part of this whole deep dive. The empty space itself, that's just a symptom.
A symptom of a much bigger shift in behavior.
Right. The true existential crisis, the one that poses a systemic risk to the entire banking sector, is that $1.5 trillion in debt that is still attached to those ghost towers.
So you have these assets producing little to no income, but they still have to service these massive, massive loans.
And the timeline here is what turns this from, a slow bleed into a sudden cliff.
This is the $1.5 trillion maturity wall we keep hearing about.
Exactly. And this isn't debt that's spread out gently over 30 years. These are huge short-term loans, mostly 5-year balloon loans.
Signed and sealed back in that almost mythical-sounding golden era of 0% interest.
When money was basically free, you could borrow at 3, maybe 4%.
And those loans, they're not coming due in 30 years. They are coming due right now, all through 2025 and 2026.
And they have to be refinanced, not at 3%, but at today's rates, 7, 8%.
So the entire financial math that justified the original price of these skyscrapers has just fundamentally broken. It's gone.
It's gone. And the average retail investor, they draw from their experience with their own home. They think real estate always goes up.
And that's the assumption we have to challenge today.
We have to. This deep dive is going to show you exactly why prime commercial real estate, and we need to be specific here, office towers, some malls, why they might actually go to zero.
Zero in terms of equity value.
For the first time in modern history, we are talking about assets whose market value is so low you can't sell them for enough to even cover the loan.
Okay, so that brings us to a really critical distinction we need to make right at the top.
Yes, absolutely. Before we get into the technicals, let's be crystal clear.
This discussion is strictly and exclusively about commercial real estate, CRE.
We are talking about office buildings. We're talking about certain types of malls, maybe some hotels. We are not talking about residential housing.
So if you're a homeowner, you can breathe easy.
Mostly, yes. The factors driving this crisis, the short-term debt, the obsolescence of the asset, this whole work-from-home shift, they really don't apply to the residential market.
Which is still driven by 30-year fixed mortgages and, frankly, a chronic shortage of supply. This is a very concentrated crisis.
It is. And it's concentrated in the regional banking sector, which means we have to sort of conduct a forensic accounting review of their balance sheets.
Because, and this is the core argument, right? The bank is currently lying about the value of its assets.
They are. The debt attached to the core of the American skyline is rotting from the inside out. So let's start with how we got here, the root cause.
The structural breakdown.
The structural breakdown.
Okay, let's unpack that. The structural shift. For the past 3 years, the main strategy for CRE landlords and the banks funding them has been, well, we call it delay and pray.
Right. They were just banking on the idea that this vacancy was a temporary thing, a cyclical blip.
They thought management would just snap their fingers, force everyone back to the office, and everything would go back to 2019.
An assumption that is not just wrong, it is economically dangerous. What we're arguing And the evidence supports this is that this is not a cyclical downturn.
This is a permanent structural break in human behavior.
It's the de-officification of the economy, a massive transition that was made possible by high-speed internet and cloud computing.
And the evidence for this being permanent is, well, it's pretty solid. We keep looking at the data from Castle Systems.
That's the key card swipe data. It tracks employee occupancy in 10 major U.S. cities.
And right after the lockdowns, yeah, there was some hope. You saw the line tick up. But if you look at the graph for the last 3 years, it tells a story of complete stagnation.
It's flat, glued at 50% occupancy, maybe slightly above.
It hasn't rebounded to 70%, let alone the 90% we saw before the pandemic.
Which proves that the other half of the white-collar workforce has found a new equilibrium, a new arrangement. And they are simply not going back to a cubicle 5 days a week.
And the shift in leverage here is really the key. I mean, employees realized just the profound absurdity of it all.
A 90-minute commute, burning $10 in gas, paying $30 for parking.
Just to go sit in a little box and join a Zoom call with people who are already working from home, the whole value proposition of the commute just vanished.
And that pushback from employees found a very receptive ear in the C-suite, with the CFOs.
Of course. The chief financial officers realized they were committing profoundly bad business.
Paying $100 per square foot for empty desks, for infrastructure that nobody was using.
Maintaining these huge, cooled, lit, fully furnished spaces for people checking emails from their kitchen table.
The cost savings were just too massive to ignore. Once a company's lease came up and they decided to right-size their footprint, maybe cut 30% of their space,
that square footage is gone forever. It's not coming back. It's a permanent reduction in demand.
If you put it in a historical context, it's like a fundamental evolutionary shift. We went from the farm to the factory in the Industrial Revolution.
Centralized production.
Then we went from the factory to the office tower in the information age. Centralized information.
But now, in what you could call the AI age, the key tools of production information, collaboration, computing power, they don't live in a building anymore.
They live in the cloud.
So the physical office, which was once an essential tool, is now, for a huge number of workers, an optional luxury.
And if you're facing economic headwinds, a recession, or critically sky-high interest rates, luxury is the first thing you cut from the budget.
And the permanence of that shift has cratered the income of these buildings.
Which leads us directly to the insolvency, to the broken math.
Okay, let's get technical for a minute, because this is where the crisis really crystallizes. Commercial real estate isn't valued on feelings or what you paid for it.
No, it's valued purely on its ability to generate income. We use a metric called the capitalization rate, the cap rate.
Right. And the cap rate is just your net operating income, your NOI, divided by the price of the asset.
It's basically the annual return you'd get if you bought the whole building in cash. So if a building makes $5 million and costs $100 million, that's a 5% cap rate.
Now, let's rewind to 2019, the profitable history. This is the simple math that built trillions in wealth.
It was so simple. An investor could borrow money at 3%.
And buy a building that yielded a 5% cap rate.
And that 2% spread, that was essentially free money, positive leverage.
Yeah.
You were making more on the asset than you were paying on the debt.
And on top of that, those low rates created something called cap rate compression.
Right. Because debt was so cheap, everyone was competing to buy buildings, which drove the prices up.
And when the price goes up, the cap rate goes down.
So even if the building's income stayed flat, investors might pay more for it, accepting a lower return, because they were just betting on refinancing that cheap debt forever.
Today, that equation hasn't just gotten worse. It has flipped completely upside down. It's a massive negative carry situation.
The Fed's rate hikes mean the interest on a new loan is 7 or 8%.
And the building, because it's half empty, is making less money. So its income might only yield 4 or 5% if you're lucky.
So the cost of the debt at 8% is way higher than the income the asset is generating at 5%.
That's the negative carry.
You're losing 3 cents on every dollar of borrowed capital every single month. And that's just the interest payment. That's before property taxes, insurance, maintenance.
And let's hammer home the difference in the loans here. This is so important. These are not 30-year fixed mortgages.
No, these are short-term balloon loans. They mature every 5 to 7 years on average.
And often, the owner is only paying the interest during that time. The entire principal balance, the balloon, is due all at once at the end.
So every 5 years, you face this moment of reckoning. You either have to write a check for the entire loan,
Or what usually happens, you refinance the whole thing.
and that's why this $1.5 trillion wall of loans maturing in 2025 and 2026 is so terrifying.
You have to refinance an old 3% loan into a new 8% loan on a building that's making 30 or 50% less money than when you bought it.
Now, this is where we need to talk about non-recourse debt. This is very common in CRE.
Non-recourse means that if you default, the bank can only seize the asset, the building itself.
They can't come after your personal wealth, your other companies, your home.
So the choice for the owner becomes purely rational. It's not emotional. It's just business.
Right. Option 1. You inject tens of millions of dollars of your own fresh cash into this failing building to pay down the loan enough to make the new 8% interest workable.
You're throwing good money after bad into a building you know is obsolete.
Or option 2, thanks to non-recourse debt,
Mm-hmm.
you hand the keys back to the bank and you walk away.
It's a cold, calculated decision. The building is worth less than the loan. The cost of ownership is infinite, so you default.
And we are already seeing this happen with the biggest, most sophisticated players.
Like Brookfield, a massive global real estate giant. They defaulted on prime towers in the middle of Los Angeles.
When a player like Brookfield, with all their resources and banking relationships, looks at the math on a trophy asset and decides it's better to walk away,
It tells you the equity value of that building has effectively gone to zero.
their default sent an unmistakable signal to the entire market.
And the market definitely got the signal. But the banks, as we're about to discuss, are doing everything in their power to pretend they never heard it.
And that leads us to the core financial scandal of our time.
Okay, let's just step back a second. If the math is so clearly broken, if these billion-dollar buildings are worth half of what they owe, and smart owners are just walking away,
Then why hasn't the whole thing collapsed? Why aren't banks failing every single week?
that's the question.
And this is the forensic accounting angle we have to dig into. The only reason it hasn't collapsed is because of an intentional, systemic strategy of concealment.
We call it extend and pretend.
And that is the scandal. It's an unspoken conspiracy of silence between the bank, the landlord, and even the regulators who are quietly, looking the other way.
Some people call it delay and pray. The banks are just terrified of admitting the true value of these assets.
The mechanics are simple, but the motivation is existential for them, especially for the regional banks.
Here's how it works. If a loan matures and the bank actually forecloses on that $100 million office tower, accounting rules say they have to sell it.
At the true current market price.
And if they sell it and only get, say, $40 million, that $60 million loss has to be booked immediately.
The 60% loss on a single asset.
And that admission of loss, that's the regulatory pressure point.
For a lot of regional banks, whose whole business is local CRE lending, taking a loss that big on a bunch of loans at once would instantly wipe out their Tier 1 equity capital buffer.
They would be, by definition, technically insolvent overnight, and they'd be seized by regulators.
So the lie is agreed upon. When the owner can't pay, the bank doesn't foreclose. Instead, they extend the deadline.
They might charge a little fee, fiddle with the interest, but the real agreement is to pretend the loan is still good.
They keep it on their books, claiming the building is still worth the original $100 million.
This is the specific mechanism. They avoid the legal requirement to do a mark-to-market valuation.
And so they are operating on what is essentially a fictional balance sheet. It's filled with zombie buildings.
Properties that are economically dead, but are artificially still walking around on the bank's books, delaying the inevitable.
And this delay, it creates a huge problem because it just paralyzes the market. It prevents price discovery. It stops new capital from coming in to clean up the mess.
And critically, it allows the infection to spread far beyond the bank's own balance sheet. Which brings us to contagion number 1, CMBS and pension funds.
Right. A lot of people forget the bank that made the loan didn't always keep it.
Many of them were packaged up, pooled together, and sold off as commercial mortgage-backed securities, CMBS.
It's basically debt securitization 2.0.
This is the modern version of the toxic financial waste that caused the 2008 crisis.
But instead of subprime home loans, we have toxic loans on empty office towers, all bundled up into bonds.
Now, we need to detail the tranche trap here. These bonds are sliced up into different risk levels, like a pyramid.
The riskiest slices, the bottom part, are called the equity or B piece. They're designed to absorb the first 10 or 15% of any losses.
Then you have the middle, the mezzanine tranches. But the top tranche is the most important.
The safest, theoretically bulletproof part rated AAA.
And that AAA paper was bought by the most conservative investors you can imagine.
Who bought it? Pension funds. For teachers, firefighters, municipal workers, insurance companies, 401k plans.
And the whole assumption was that even if a few buildings failed, the losses would never be big enough to brain through all the lower layers and hit that AAA barrier.
That theory is now dead.
Because the losses from these sales, we're seeing buildings sell at 50, even 80% discounts. The losses are so severe, they're burning through those lower tranches at an incredible speed.
We are now seeing real-world evidence of losses starting to hit the safe AAA-rated bonds.
And that is the systemic risk. The contagion isn't contained on Wall Street.
No, it means the retirement savings of millions of ordinary Americans are now at risk. Their pensions are holding the bag for ghost towers they've never even seen.
All because a rating agency said the debt was safe.
And that risk is tightly linked to contagion number 2, the vulnerability of the regional banks.
When you think of finance, you think of the big global giants. But in CRE lending, the risk is all local.
Regional banks, the small and mid-sized lenders, they hold nearly 70% of all commercial real estate loans in the U.S.
It's vital to contrast this with what happened to Silicon Valley Bank. SVB failed because of a duration crisis.
A mismatch between the long-term bonds they held and what they owed depositors when interest rates shot up.
This CRE problem, though, this is a classic credit crisis.
This is about the fundamental quality of the loan itself. The borrower literally cannot repay because the building, the collateral, is no longer making money.
And historically, credit crises are far more destructive to the banking system.
So let's talk about the trigger. When the regulators or the market finally force that bank to stop pretending, and they have to mark down that $100 million loan to $40 million.
That 60% loss doesn't just hurt profits. It instantly vaporizes their most important buffer, their shareholder equity.
And this is exactly why smart money is actively shorting regional bank stocks right now.
They know the balance sheets the public sees are mostly fiction, propped up by this refusal to mark to market. They know the insolvency is hidden just under the surface.
They're just waiting for that maturity wall to come crashing down and force the liquidations.
So the predictable, though very painful outcome is a massive wave of bank consolidation.
Hundreds of small, vulnerable regional banks are going to have their equity wiped out. They'll be seized by the FDIC and then swallowed whole by the giants. It's a forced restructuring of the entire American banking landscape.
So when you're facing a problem, this big empty buildings that can't support their debt, the most common suggestion you hear is just convert them into housing.
It sounds perfect, right? A two birds, one stone solution.
Solves the office problem and the housing shortage.
Except that is the conversion myth. And it is soundly debunked by simple physics and astronomical costs.
The architecture of a modern office building makes it nearly impossible for most of them.
Okay, let's talk about why. The main problem is the deep floor plate.
Office towers are designed to maximize rentable square footage. So you have these huge, deep floors, maybe 60, 75 feet from the windows to the central core with the elevators.
Which is fine for cubicles. But residential buildings have different rules. Apartments legally require natural light and ventilation. You need windows in living spaces.
So if you try to carve apartments out of that deep floor plate, you end up with this massive, unusable, windowless dead space in the middle of the building.
You might see the closet in there, maybe a hallway, but you cannot put a legal, desirable bedroom in that zone.
To solve that, you need a radical, and I mean radical structural change.
You have to gut the whole central core, carve out huge atriums to let light in, which dramatically shrinks the amount of space you can actually rent out.
And the cost is just staggering. You have to redo all the plumbing. An office floor has one big restroom core.
Residential needs dozens of kitchens and bathrooms on every single floor.
That means punching new holes through load-bearing steel and thick concrete. It's immensely expensive and structurally complex.
Often, the cost to do all that is higher than just demolishing the building and starting over with a purpose-built residential tower.
And the numbers back this up. Goldman Sachs and a bunch of engineering firms, they estimate that only a tiny fraction,
maybe 2 to 10% of existing office buildings are actually suitable for conversion without these crippling costs.
The rest are just economically and physically obsolete. The sources call them, and this is pretty stark, concrete coffins.
The conversion myth is a comforting story that lets us ignore the reality that these assets are just broken.
And this brokenness doesn't stay inside the building. It spills out into the city itself, creating this self-reinforcing urban doom loop.
And this is where the financial crisis becomes a real societal crisis.
You, the listener, you have to understand the local impact of this. The doom loop is this disastrous death spiral that starts with a private building losing value and ends with the city's tax base being crippled.
Let's walk through the mechanism. When office towers are empty, the economic activity that keeps a city alive just vanishes.
The hundreds of thousands of daily commuters aren't there anymore.
So they're not buying that $15 salad from the deli. They're not paying $50 a day for parking. They're not taking Ubers to lunch.
All that foot traffic disappears, and so the local businesses, the restaurants, the dry cleaners, they fail. They close for good.
And at the same time, cities rely on two key revenue streams: commercial property taxes, which are based on the inflated value of those buildings.
And in many big cities, municipal wage taxes paid by those commuters.
When the buildings get devalued by 50% or when workers just stay home in the suburbs, that city tax revenue collapses.
And the consequences are immediate and devastating. The city has to cut services.
Which means fewer police on the street, dirtier subways, closing libraries, huge cuts to public schools.
And that creates the feedback loop. The city becomes less safe, less clean, less attractive.
Which drives even more residents and businesses out. Which increases the vacancy rate even more, which devalues the remaining buildings even more. The spiral just tightens.
And we are seeing this in real time. Cities like San Francisco, St. Louis, their downtowns feel genuinely hollowed out.
It's leading to huge problems with crime, addiction, homelessness, all made worse by a cratering city budget. San Francisco is facing a property tax shortfall in the hundreds of millions.
And the investor community, they're reacting rationally to this chaos. The smart money isn't just avoiding office buildings.
They're basically redlining entire city zip codes. They're looking at the decay and deciding the whole city is uninvestable.
Why would you put capital into any real estate there, even residential, if the public services are crumbling and the city government is failing?
It ultimately destroys the value of all local real estate. The crisis goes way beyond just bank balance sheets.
But if the banks are refusing to admit there's a problem and the cities are decaying, who finally steps in to force the correction?
Well, where there's profound institutional failure, there is always profound opportunity for those with liquidity and the stomach for risk.
And that leads us to the final act of this crisis, the arrival of the vulture capitalists.
The vultures are not scared. They are mobilizing. We're talking about the heavyweights, Blackstone, KKR, Starwood.
They're actively raising huge pools of money, dedicated funds specifically labeled distressed credit funds, and they're targeting this $1.5 trillion mess.
Their strategy is patient, it's ruthless, and it's tactically precise. They're just waiting for the exact moment the bank can't pretend anymore.
Either the maturity wall forces too many defaults, or, more likely, the regulators finally step in and force the banks to liquidate these toxic assets to stay alive.
And when that forced sale happens, the vulture swoops in. They're not buying the building at first, they're buying the bad debt.
So they buy the bank's toxic $100 million loan for, say, $20 million. They buy the distressed CMBS bonds at 10 or 20 cents on the dollar.
They provide the essential liquidity that's needed to get this toxic waste off the books of the banks.
Then, once they own that discounted debt, their playbook is simple. They force the foreclosure.
And once they take possession of the building, they own it with a clean balance sheet.
And that is the financial reset, because their cost basis in the building is now $20 million, not $100 million.
So even if the building is only half full, suddenly the math works again. A small stream of income on that deeply discounted price translates into a very attractive cap rate.
They've successfully destroyed the old inflated debt and replaced it with clean, cheap equity.
And now the vulture owns a prime asset in one of the most valuable locations in the world for pennies on the dollar.
And they're perfectly positioned to redevelop it, demolish it, whatever, while the old owner and the bank absorb the full, devastating loss.
So this whole process, it raises a critical philosophical question for you, the listener.
Is this vulture capitalism inherently evil? Because it requires and profits directly from institutional failure and widespread economic pain.
I mean, it makes a few people exponentially rich, while local banks and pension funds could be collapsing.
But let's explore the counterargument, which is that the vulture is maybe a necessary, if morally ambiguous, operator.
The vulture provides the one thing the system desperately needs to move forward: liquidity.
Right. If everyone, the banks, the owners, the regulators, is stuck in this conspiracy of extend and pretend, the true market price just stays frozen in denial.
The capital is stuck. The city decay continues. The vultures perform a vital market clearing function.
They force the system to acknowledge the true market price by being the only ones with enough cash to buy up all the trash.
So their function, however distasteful it might seem, is a kind of systemic triage. They absorb the toxic shock. They recapitalize the system, and that allows for the eventual rebuilding.
They're the market's cleanup crew, forcing the creative destruction that's needed to reset the financial clock.
So the final verdict for you is less about morality and more about strategy. The skyline's falling, assets are being destroyed on balance sheets.
But the people who held on to cash and liquidity, the vultures, they will be the ones who own the future, regardless of the moral cost. They are playing the long game.
A very long game, betting on the total collapse of these debt-inflated valuations.
This has been an extensive deep dive into the $1.5 trillion commercial real estate cliff. Let's try to synthesize the three main actionable conclusions for you to take away from this.
Okay, first, a technical recommendation. You have to exercise extreme caution with any REITs real estate investment trusts that are heavily exposed to office space.
Specifically, the office equity REITs, the ones that actually own the buildings. They're holding these financial zombies. Their balance sheets are inflated. Avoid them.
And also be aware of the mortgage REITs that might be holding the low-rated tranches of those CMBS bonds we talked about.
Second, exercise extreme caution with regional banks. If you're an investor, you have to investigate your local bank's exposure to CR loans.
Remember that the insolvency created by extend and pretend is hidden. The maturity wall will force write-downs, and that could lead to instability, failure, or a forced merger.
This is a credit crisis, and it starts locally.
And third, liquidity is absolute king. In a deflationary crash driven by debt, which is exactly what this is, the person with cash dictates the new, lower price.
If you have liquidity, you are in a position of power to capitalize on the distress when the vultures start their work.
Now, here's where it gets really interesting. The provocative thought we want to leave you with.
We've established that the vast majority of these office buildings, they can't be converted. The 2 to 10% suitability rate.
And we've seen how the doom loop is just crushing city revenue through lost property and sales taxes.
So the core question is this. If these massive, obsolete buildings cannot be effectively taxed, and they can't be turned into profitable housing,
what is the ultimate cost to municipal services? And how long can major U.S. cities like New York, Chicago, or San Francisco avoid outright municipal bankruptcy?
before they have to resort to a massive, painful restructuring of their debt, their public employee pensions, their entire city structure?
It's not just a real estate crisis or a banking problem anymore. It is a structural crisis of civic infrastructure and governance that's going to determine the future of our downtowns for the next generation.
Think about that next time you walk through your downtown. The towers may be standing, but their foundation is debt. And right now that debt is worthless. Thanks for joining us on The Deep Dive.